is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. Hello, zingers and traders and investors. Hope everyone's having a good morning so far. Looks like the market is. At least S&P 500 was up about 0.5% last time I checked. Seems like every single day recently we've just been inching higher. Santa Claus coming to town a little early, maybe. People are still talking about this Santa Claus rally. A lot of people are like, did it already come? Is it still coming? We will discuss that later in the show. But first, we've got my man Ryan Pannell from KAIJU hanging out backstage today. We're going to be talking order types in another episode of our educational series, which we've been doing with KAIJU every single week, every single Tuesday. So if this is your first time tuning in, again, KAIJU, doing some very exciting things in the ETF and AI space. And Ryan has years and years of experience as a professional trader and now managing that fund. So we're getting a lot of invaluable insight from Ryan about how to kind of take our trading from, maybe a rudimentary, kind of retail stance to more of learning how the actual professionals are doing it and the different types of tools and things that professionals are using and thinking about that maybe we don't. So without further ado, let me go ahead and bring my man Ryan on. Ryan, how we doing today?
Good, Aaron. How you doing? Good weekend?
Yeah, man.
Monday,
here in
Santa
Detroit.
Claus rally.
Yeah, I mean it's been a big rally, as I'm sure I don't need to tell you. And now, what's funny, Ryan, is everyone, people just change their perceptions with the market so fast, right? Now that the market's hot, everyone is adjusting their price targets for next year. Everyone's saying, "Oh yeah, we've been bullish for the last 6 months," all this stuff, and it's like, well, I don't know. The data shows that a lot of people were bearish, 6 months ago, and now are turning bullish. But often that happens is that price will predate sentiment, and sentiment will kind of just follow whatever the price is doing.
Absolutely. I mean, you've seen it before, right? I mean, market outlook is the predominant sentiment, whether that sentiment makes sense or not. You see, we get into COVID, market goes off a cliff, hangs out there for like 5 minutes, and globally everyone sort of says, yeah, I know that everything's shut down, supply chains have been destroyed, but I think I'm going to bid this up. And up it goes, much to everyone's shock. But it doesn't matter, right? I mean, we're talking about stock speculation. If anybody thinks that Tesla's current fair market value is an accurate representation of the breakup value of that company, you're dreaming. That could be applied to 99% of the S&P 500. It doesn't matter. That's the price that it trades at. That's what people are willing to make a market around. That's the reality. So
100%. Well, again, we've been doing this educational series every Tuesday. We're getting into order types today, which I'm very excited about because, it's something that I never really think about, Ryan. I just kind of go out there and I make my orders, I buy my stocks, but, we've discussed at this point our strategy. We've got our strategy. We're ready to go. We've identified an entry point and we're ready to make an order. What are the basics? What is a limit order? What's a market order? And when should they be used? Is there a time for one or the either, or should you always stick to one?
yeah, that's a great way to start. When should you use them? Like never. Those are two tremendously awful order types for entering a position. They have a use. We'll talk about that. It's appropriate that we're doing order types today. We sort of dealt with risk management. We first focused on, how to stay out of trouble. Now we're going to teach you how to get into trouble. So here we are, right? You've got your risk mitigation is now on point and you're ready to fire your orders. How can you do that in a more responsible way? Okay. So market order, I'm sure most of your viewers know what this is. Market order, any order type, let's just pause for a second. Any order type is a small series of instructions and permissions bundled under a single term, right? That's essentially what it is. It gives your broker permission to do something. So a market order says, I want to buy or short this stock for any price, so long as it's in between the NBBO, right? The national best bid offer, right? The bid ask spread, another term for it. So as long as it's in between there, it's fillable. Why is that a terrible order? Well, there's two reasons. One, you're in the position immediately without forcing the stock to move in the direction you think it'll move in. And we'll talk about that in a little bit. But really, by giving permission to the broker to fill you anywhere in the spread, if that spread is moving quickly and the broker feels like filling you out of their inventory, all brokers hold inventory and they have the right to fill you out of their inventory. Your order might not ever show up on the floor. You throw a market order out there, they're like, hey, sweet, I wanted to get rid of this stock anyway, and you are literally willing to pay anything for it, so long as it's in between these two fast-moving points. Let's sell you that to my advantage. So we don't use that for position entry. A limit order is basically the same order, only you have a cap on it. It's anywhere within the NBBO up to this point. So if you've given the broker permission to do that and the spread is fast moving, I'm sure a lot of your viewers here trade fast moving equities. So if that's the case, where's the incentive for best price execution for you? It's like, well, you're willing to pay, stocks $11, you're in, and you're willing to pay $11.38. Where's the incentive in a fast moving spread, a ripping stock to not fill you at the limit? You gave them permission to do so. Why would they not do that? Okay, we do use limit orders for options trading, and we do use market orders for stop losses, but never, 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 never for entry. Not ever. For those reasons, you're just going to get terrible executions and no capacity to guard against a whipsaw. So there's my hate on market.
So what about, I'm curious now because, we have a lot of our audience, day trades as kind of a hobby, and they, like you said, they're trading kind of these quick things, but some of them might also have separate investment accounts and portfolios. I mean, if you were just going to buy a stock that you wanted to hold for 5 years, would you still avoid a market or limit order?
100%. You have given away control of your execution price to somebody else who has complete legal permission to execute to their benefit within a very loose set of rules. Now, even worse, let's say you're an odd lot trader. You trade fractional shares. You're not trading round lots of 100, right? You're odd lot. You're not protected by the NBBO in the first place. So you can sit off to the side while the spread moves around. They compile a series of odd lot orders together so they can make a whole order. By then, they're going to execute that way far away from where it was when you entered. So you never want to do that. You want to control your entry price. And you do that by using, if you're going long on a stock, you use a buy stop limit order. That is what we all do. And if you're selling it, it's a sell stop limit order. What the hell is that? Okay, so let's just pick a random example. You're going to buy stock XYZ. It's $10. I'm going to set a buy stop at, let's say, $10.18. And that means that I'm going to force the stock to move into my buy stop to trigger it. That's going to save me from a whipsaw. If I market buy that and it ticks up to 10.04, rolls over and dies, well, crap. Now I'm in the position and I got to manage. Maybe I'm going to hit my stop loss because I caught not the beginning of a meaningful surge, but the tail end of a lame run. Now, if I set it for $10.18, it has to move substantially with some energy into my buy stop. Okay, so now it triggers, but I don't want to pay any price for it. I want to control the price. So I use a limit on top of that, buy stop limit order. So the buy stop triggers at 10.18, call it 10.30. That's it. That's the most that I'm willing to pay. So I have guaranteed that I'm only going to be filled between 10.18 and 10.30. If the stock just blasts and rips right through that, you don't want it at any price, right? I mean, you're not willing to pay anything for it. You have a specific idea of what you want to pay. Anywhere in here looks good. Okay, fine. So dictate that. Has to move into my buy stop, trigger the order, no further than here. That gets me filled. Same thing short. I force the stock to collapse into my sell stop, but I set a limit. So if it just craters, if it is just hurtling downwards, I don't want my average fill price to be way, way, way below where I analyze this thing, because I'm going to end up having to cover super fast again if it whipsaws. So that is called bracket order in the professional space, or buy stop limit order, sell stop limit order. Same thing for position trading, Aaron. Your question, if I want to buy this thing and hold it for 10 years, why wouldn't you control price, right?
Right.
You set this corridor and you're like, yeah, whenever you get there, you could do good till cancel. If you were like a position trader, you set this corridor up, which is what institutions do. And it's like, if that falls into that corridor, I'll take this much of it. No more, no less. It'll fire and stop right there. So that's how we get into positions generally in equity trading.
Yeah, and the reason I ask is because literally just this morning I went into my Roth. I still had some, end of year contributions to make to catch up. And I was buying a stock and I was like, well, and it was already up, 8 or 9% this morning. I was like, maybe I don't want to buy it up here, but I was like, you know what? It doesn't matter. I'm gonna own this stock for a while anyway. I'm not buying to trade it. And so I just bought it with a market order at whatever it was. And I was like, and then right as I was doing it, I thought about you, Ryan. And I was like, I bet you Ryan's gonna tell me this is not what I should be doing right now.
I was going to tell you that was a terrible idea.
Well, I'm glad I went out and got did it ahead of time at least. So now I can at least say, well, I know better now and look back on it and realize what I did wrong. So next time I know how I can set myself up for success better.
Right. I mean, like, again, if you're planning on holding this, then and it's up 9 or 10%, and you set a buy stop limit order above the current price and it never makes it, and it tanks and it goes down 9, 10, 15%, and it bottoms and it recovers, and in 2 months it's back up to where you would have bought it, using the buy stop limit order saves you from holding this thing that whole time. So it continues to move up, it triggers. I mean, with something that's up 9 or 10%, you want to do an average run gain analysis against previous runs. How far does this thing run when it runs? If the average run gain is 9 or 10%, it's about done. You kind of missed it, right? But if the average run is like 20%, you're halfway there. Okay, set your buy stop limit order above, let it enter that price bracket, execute, you're good to go. If it doesn't make it, you move on, put your cash somewhere else, set an alert, or you can just leave that bracket. If it ever comes back there, you'll take it, right? Because you want it in the first place.
Right. So let's say we've made our order now. We've set up, the stock went up and hit our price that we needed to trigger that buy. We have it. Now we'll talk about order types when you already own the stock. What's a stop loss? And when should someone use
that's the first thing? Good. I love it. Like, continuing on from our last question, that is the first thing you do. So you don't set all of your orders together, right? Because if I set my buy stop limit order and I set my stop loss and the stock does not hit my buy stop limit order and the stock craters and hits the stop loss, I don't hold the stock. So that stop loss will turn into a short order if I don't already hold the stock. So you don't want to add the stop loss until you're in the position, right? So you don't line it all up together. You buy stop limit, you'll get an alert on your phone or you're watching your trade system or whatever it is, right? You're in the position, then you're going to go, you've done your risk analysis that we discussed last week, and you're going to put your stop loss in. And remember, all stop losses are good till cancel. You do not put GDO or good day only for stop losses, because you'd have to reset them, and that's not a true acceptance of the risk. Remember, we're using the stop loss as a, if it gets here, I'm wrong. I'm cool with losing this much money. I am out. Close me out. And it's a market order, not a limit order, because it's not close me out, but if it gets worse than this, what are you going to do? Not fill? You're going to hold it as it goes further down? You just want out at all costs at that point. So stop loss is just a stop market order. Stock collapses, boom, you are gone. That's the next thing that you are going to do. Now, in terms of once you're in the position, the other side of that, let's be optimistic. Okay, if you're not going to monitor your trades and you want to just leave a profit taker on, you can do that, right? Which is yet another sell order, right? But now I'm going to set it way above my bracket. If it gets up here, I'm good. I'm going to take my profit. I don't know a lot of traders that do that. I doubt your viewers do that because, when you're at maybe that's a middle of a powerful run, maybe it's near the end of a run, you want to do a run gain analysis before you take your profit. Like you don't want to just, hey, you're closed out. Congratulations. You made
Yeah.
22%. It could have been 50, but you're out at 22. Bit lazy, right?
And we
So
talked about last week how to make more on your winners than you do lose on your losers. So it seems
yeah,
like limiting your cap on what you could make on your winners would be like a bad way to go about it.
exactly. What you can do, which we generally do, is we set a profit alert, right? So there's an alarm that goes off when it gets to a point that says, okay, around here, you should start looking at exiting. And you can, now you're going to pull up your intraday minute chart. Is it struggling? Is it near its peak? Do you have some sharp retracements? Are the quantity sizes for the sell orders large relative to the buy orders? That's important because if you see that, if there's heavy volume each time it ticks down and light volume market orders on the way up, that's retail traders trying to catch the tail end. It's FOMO traders. You don't want to be in that group. The big lots exiting or profit taking by institutions, that's when you want to go. So you're going to look at your intraday charts. If you don't want to sit around and manage this, you can use a dynamic trailing stop. Almost all software will have a TRL or trail, which you can add. And you'll set a stop and you could set it like right above current price if you wanted to start trailing right away. And then you set the amount of the trail. Usually you can use a dollar amount or a percentage amount. So stocks trading up, I set a trail stop and stock triggers my trail stop. And let's say I have 1% or 0.5% as my trail. That means that the trailing stop will keep going up as the stock goes up. The hard stop is 0.5% below that. So if the stock retraces, my trail doesn't move anymore, and it's got this 0.5% exit below. So if the stock price goes down, but it doesn't touch it, and it makes another surge up, the trail will move up again, move up, move up. And when it stops doing that and it collapses, once it goes through that floor, you'll market exit. So that's a good way to try to eke out every last dime without sitting there and watching intraday ticks go on and on and on and second guess. You could just sit that there. If you're going to use that, only additional piece of advice is it's important to look at the intraday movement, use the minute, and if you want to see clumps, use the 3-minute time frame, but use the minute and see what the pullbacks generally look like. If your trail exit is too tight, you might as well just close the position. It'll trail up and you'll be out, 30 seconds later. So see where it looks like, if it goes below, it's probably going to roll over, and make sure that that's the space, again, dollars and cents or percent where you set that trail. So that's another thing that you're going to use.
Got it. And so we've talked about, market orders, limit orders, and why to avoid those. We've talked about that kind of bracket order setup, trailing stop. Are there any other order types, and what situations would you use them in?
Sure. If you have access to a more advanced broker, say what we would call like a semi-pro broker, interactive brokers, something like that, you're going to see on your order ticket entry widget, you're going to see a series of different types of orders, and you're going to see routes that you can choose. Route is probably set to auto, and you are fine leaving it there. The order types are going to be market, limit. You can do the buy stop limit. Some will say BSLO right there. So that's going to ask you for the stop and the limit. You'll have trail. That might be grayed out if you're not in a position, because what's it trailing? Depending on the broker. Some of them you can actually trail your entry. I'm going to trail it up and then I'm going to short it after it collapses. But I wouldn't recommend that. Use the bracket order, because again, you got a market order with the stop. And then you're going to have these exotics, right? You're going to see things like iceberg, or stealth or sweep to peg or something like that. SMGD. Those are specific pro trader and institutional order types that are not going to be meaningful for you. So iceberg order, for example, is for larger sizes, and you only want to show part of the size to the market. So again, the concept of the iceberg, right? You're only seeing the tip of the iceberg. So I want to buy or sell 10,000 shares of ABC, but I only want to show 1,000 or 1,500 to the market. So I'll choose iceberg. I'll choose 1,500 as my show size, and I'll see what it's called a feeler order. I'll see what the uptake looks like at 1,500 orders. And the rest of my orders stack behind that. So when the 1,500 trigger, if there's more size there, it'll just suck up the rest of my order without me loading up a 10,000 lot order that people can see on level 2. So that's when you'd use that. But if you're trading 500 shares, 1,000 shares, a couple hundred shares, there's no use iceberging like 100 shares. That's not helpful. So you need to use that. Sweep and peg is for fast moving markets, trying to find best price execution. Again, large size, and the spread is rapidly moving. So instead of just getting filled in there, instead of constantly trying to hit a moving target, you have these algos that will sweep the spread and try to fill at a specific peg, like a mid to bid, mid to offer, something like that. Stealth is like a fake dark pool order. You don't have any access to unlit trade venues as a retail trader. So I think that one, I saw one broker called it ninja, and I just couldn't believe it. But that's something where it's claiming that it's hiding your whole order size and sending it to an ATS, alternative trade system, and it's really not doing that. I find that a bit, that's pushing the line of decency. So those you don't have to worry. The routes you actually can use. It'll be set to auto. If you are watching the depth of book, if you are watching on which exchange most of the trades are being executed favorably, we call that the axe, right? Which of the exchanges is the axe for that stock? It's Amex, it's SIBO, it's BATS, it's PhilX, it's whatever. You see that showing up if you have that type of data feed, and that's where most of the executions are going, then you might consider routing there, bearing in mind that different exchanges and routes have fees associated with them. ARCA, for example, is very, very fast and high liquidity, but it's a little more expensive to route to ARCA than somewhere else. So that's the routing part and why you might choose that. Generally, you are fine with your buy stop limit, your sell stop limit, and an auto route 99.9% of the time.
Got it. So if someone did want to use some of these more exotic, trade types to kind of, try and maximize their profits, what would you, I mean, for just an everyday person, like which ones would you recommend, and how would they kind of utilize those to maximize their profits?
So the first thing I do is contact the broker. And if it's not in the help files, like Interactive Brokers, I know for a fact you can go to the help files, you can look at order types, and there is a description of each of those specialty order types. If you do not understand what it means, cut that out, open a support ticket, paste it in, say, I don't know what the heck this is telling me to do or what this is supposed to achieve. Please explain it to me. It's their job to do that. So they can give you a more layperson's description of what that will do. And then you can decide whether or not that's meaningful. Personally, at your average retail investor, average retail trader level, I don't think many of those are going to be useful. Maybe sweep and peg or post to last if you are trading something with an enormous amount of liquidity in a spread that's moving very, very quickly. There's not a good way to capture mid if you want to average to mid without using that type of an order. Again, I would highly recommend the buy stop limit and just let it fill in your bracket because you're okay with that price range, right? You want it here. You're okay with up to there. So anywhere in there is good. You don't need the exotic order type. What I would say is more useful if you want to accumulate reasonable size in something with low liquidity, because I know some of your viewers trade lower liquidity stocks, maybe slightly lower price stocks, so-called penny stocks. If a low float, low liquidity penny stocks, if you're looking at the minute time frame, the 3 minute, and you're just seeing dashes, like there are minutes or 3 minutes with no prints, then you want to control your order a little better. And what you can do with that is see if your broker offers an accumulation distribution algorithm, ACDIST, we call it. Interactive Brokers does for sure. And I don't mean to keep hyping Interactive Brokers. I just know that they have the tools. Other brokers that you use may totally have them. And so what that does is let you set that bracket, but you can set price and time offsets. So instead of trying to get it all at once, because it's low liquidity, you're going to blow through the spread quickly. You get a partial fill. You'll be on the other side of your limit and then not able to fully fill. And you've got to go back and try again or wait for price to settle. You can have this thing buy 100 shares at a time every 10 minutes and set it to go for 2 hours or whatever you want to accumulate. So it's just going to buy 100 shares at this price, again, buy stop limit here, and then shut off. And it'll wait. And when it comes back, 8 minutes later, 6 minutes later, 10 minutes later, whatever your offset is, if it's between your 2 points, it's going to buy another share, another 100 shares. And what you'll see is the spread will spike after you've been filled. It'll sit there and it'll settle, and then you'll get filled again. So that, to my mind, is more useful in a retail application than an iceberg or SMGD order or something like that, which is just kind of pointless.
100%. And one thing I'm curious about, Ryan, is do markets treat different order types or different size orders differently, or do they treat everything the same? And what should traders know about this, and how maybe the market is treating their order types differently than other traders out there?
Right. That's actually a really good question, Aaron. And I think not a lot of traders know this at the beginning. So we'll start with the NBBO, which we talked about before, the National Best Bid Offer. And that's just the bid-ask spread. You see it, anything that's trading, anything that's quoting will have a bid and the ask. In between the two, there's your spread. And the law says that if you enter an order that's marketable, you must be filled by your broker, by the market maker, in between the NBBO. Right? Now, the spread can be moving, and if it moves fast before you're filled, they're not obligated to fill you where the spread was when you put your order in, hence using these bracket orders, etc., as the spread is moving. But if you enter an order, you can't be filled below or above the NBBO. And price, time, and quantity matter. You send your order in, whoever gets there first is getting filled first. If the spread is there and you have a marketable order, you're guaranteed to fill there. If you do not have round lot orders, you're buying 38 shares, 7 shares, 15 shares, 83 shares, you're considered an odd lot, and legally you do not get the protections of the NBBO. What happens is your little order sits off to the side and a bunch of other odd lots come in, and then the broker makes up a whole lot off of that and then sends it out. So bear in mind that if you're not trading whole lots, 100 shares or higher, you are not afforded the NBBO protection. So it's a little dangerous. Also, pre-market and aftermarket is not for you. That's going to sound crappy and elitist. It's not an extended hours trading opportunity. It's a counterparty inventory control time, right? Like, we're calling counterparties and we're shifting shorter long stock that got assigned after an expiration Friday. No protections exist pre and post market. NBBO out the window. This is like a direct person-to-person conversation.
Interesting.
And kind of anything goes. So I know everybody wants to get access to pre and post market because they think it's like this kind of secret club. It's like, well, hey, maybe I could trade a little bit before the market even opens. Very dangerous because you are outside of the SEC protections. You're basically taking, your fills, your deal into your own hands. I would not recommend that unless you're trying to shift assignment that happened to you post close or at close previous trading day on like an expiration Friday or something. And even then, you'd want to do that with some guidance. So you don't want to do that. And then finally, what I'd say is in terms of the size, most retail traders and investors have this huge advantage, right? I mean, the media, other professionals tend to treat retail investors and traders, you guys are so small, you have these little orders. Are you kidding? The agility that's available to the retail sector is unbelievable. Like, you are in a position probably penny accurate whenever you feel like it. Like, for the rest of us, it takes forever to get in and out of positions. Like, if I'm trying to sell out of 750 spreads of Disney under pressure, it's going to take, like, I'm going to be on the phone with a counterparty as I'm offloading these short spreads under pressure. I'm literally causing the counterparty or the market maker to buy the stock that's hurting me to offset their own risk. Essentially, my offload is causing me greater pain. That will never happen to you. You'll be offloading like 8 spreads, 6 spreads. Boom! At the mid to offer, you are done, clear, and on with your day. So in terms of being treated fairly or unfairly by the market, I would argue that small lot traders, not odd lot, but small lot traders have a huge execution advantage. You should absolutely take advantage of that.
Yeah, that's a great advice because Ryan, I was in that camp definitely that thought, oh my God, my broker is offering more and more extended hours trading. This is great. I have more access, but really, maybe it's not the best time for me to be trading in those times. As you said, there's not as many protections. It might not be as clear as what's going on as that, during the regular market. How does AI factor in here? I mean, when it comes to order types and all this stuff, what should traders be on the lookout for?
Okay, so we've talked a little bit before about AI in flow predation, so the manipulation of flows. Again, this really only happens because of the overuse of market orders. If everybody used buy stop limit orders, you're stopping flow predation algorithms from shoving the spread far enough to disadvantage you extraordinarily, right? Because you have a contract when you've submitted your buy stop limit order that says, between here and here, that's it. All of a sudden the spread surges and your order is going to shut off. Partial fill, no fill, whatever it is, you're fine with that. Come back to me and we'll trade again. Let's see if we can't make a deal, but not at any price. So by using market and limit orders, you're making it easier for these systems to treat you as like feeder fish. And certainly when it comes to like signal crossovers, we've talked way back in the indicator, please don't use MACD because flow predation systems will try to move markets based off of a MACD crossover they know you're going to red light, green light trade on. So when there's a crossover, you get these algorithms that will kick in, try to, because they have enormous volume to use to do so, it's completely legal using the MBBO, combination of buy and selling, move that spread, kick your market order, and then you'll get whipsawed. Because once they've exited, what do they need you anymore for? Thanks for the extra liquidity. We're done. Stock collapses. You don't get the follow through. Sometimes you will, sometimes you won't, which is why MACD persists in a retail trader's toolkit, because you probably had some good experiences with it, and then you've had some terrible experiences with it. So be aware of that. My fear, I haven't seen this yet, honestly, and like we ingest the entire stock market at the tick level every day and examine 220 terabytes of tick level data. We see every print of every stock anywhere in the United States. So when you're looking at that, thankfully, I haven't seen this yet, but it will show up. These AI systems are going to try to mimic retail sentiment. And you watch this, right? I mean, I'm presuming that most of your viewers are watching the prints for whatever you're trading. You're watching the order flow for sure. And you can see 100, 100, 100, 100, 100 constantly. maybe some odd lots flow through, a little bit of size here and there. That's going to look like retail sentiment to you. Or it's a sliced order, right? It's accumulation order that's slicing a larger order and sending it out bit by bit by bit. And so if you're seeing this positive printing up at the offer over and over and over again, the spread's moving up, you're excited, you only wanted to buy 200 shares, but man, this thing is kicking. And no one's getting filled at the bid. Everybody's getting filled at the top of the spread. Spread's moving up. Maybe I'll take another 500 here. That's the goal, right? Bid up, bid up, bid up, buy it, and then you're into their flow predation. So I wouldn't say necessarily like look out for that, but it's weird if you're watching order flow and all of these 100-lot orders are printing near the offer. That's something that you sort of stop and step back and consider. Also,
Yeah.
Bad algorithmic distribution or slicing, you may be watching order flow and you see like a bunch of weird orders, 1,348, 1,348, 1,003. Like you'll see this repeat. And then you'll see like one closing order, 238, something like that. That's the world's laziest accumulation algorithm trying to slice up 20,000 shares. It's randomized it into these idiotic random slices, gets almost to the end, and then it fills it with this one last lazy fill. So if you see that, you know that you're looking at algorithmic accumulation. That's not a person doing that. No person does that.
Those are just a lot of things, Ryan, that's great information to have that I never even really would have thought about like in my own trading journey. So I'm glad we got to touch on it today. We've talked about basically every single different type of order type out there. If you guys, again, ever need to, refresh, go back, you can always go back on the YouTube video and rewatch some of the sections. But Ryan, let's get into our KAIJU kicker. I'm going to go ahead and pull up and we'll hit all the big points we hit on this week. Little recap of the lesson today. Walk me through it.
All right, I gotta lean up here because I can't see this tiny little screen.
You want me to read it? I can read it for you.
You read it. You read it.
All right. For equities trading, always use a BSLO, buy stop limit order. Never use a limit or market order for entering an equity position. And that's important. That second one up there, guys, that second bullet, never use a limit or market order for entering an equity position. Keep that in mind because I think most brokerages will, offer you one of those two options as the default. So unless you go out of the way to change it, chances are you're using one of those right now. Never use a limit order for exiting an equity position. So that's what we talked about. You don't want to kind of limit your gains ever. You want to limit your losses. We talked about this last week. Limit your losses, but you don't want to limit your gains. When you enter a new position, always enter a stop loss set to good to canceled. If you don't, you're not actually accepting the risk of the trade on entry. And then finally, do not use exotic order types or routes unless you actually know what you're doing. So yeah, Ryan, any comments, any final thoughts?
I think that sums it up. You'll find, I think if you start using the buy stop limit order, the first thing you're going to notice is you will 90% of the time avoid getting whipsawed, right? You've probably experienced this, like moving up, I'm in the position, 2 ticks later, it rolls over, dies, you're miserable. You're now watching this negative number in your portfolio. So the buy stop limit or sell stop limit order will generally keep you out of weaker price action. That's a good thing. Okay, great. The stop loss, I'm not going to go into because we covered it the last time. And in terms of the exotic order types and routes, again, these are for specific use at the institutional or large lot level that don't necessarily apply. It's not a better order type. Like when I started getting into this and I was making that early transition from retail investor to small fund manager, or I guess portfolio manager first for a hedge fund, I was so excited to get my hands on these exotic order types. And like 75% of the time, I just sit there watching my tickets not fill. And it's like, what? But this thing is like, you read the description, it sounds awesome, constantly blast sweeps the bid-ask spread, aiming for excellent execution above the mid and blah, blah, blah. And it's like, didn't happen. I go back to the buy stop limit order and I be in my position happily. So you don't necessarily need them. You for sure don't need them for 99% of trading. So don't feel like you're missing out. They're not overly helpful. If you are trading size, yeah, fine. You want to try out an iceberg because you want to buy 10,000 shares of something, give it a shot. Show 200, show 500 to the market, and then see how that's picked up and how the rest of your size is filled if you want to try that, but you don't need to do it.
There you go. I mean, again, Ryan, this has been all great tips. I mean, things that if I would have known this 5 hours ago, I would have made a different, I would have traded differently. I would have made a different, investment this morning, a different order type for that investment, I should say. So again, I mean, I think it, might not be one of the sexiest topics that people talk about, order types, but I think, one of the most useful and tangible episodes we've had in terms of, I'm sure a lot of people now, the next time they go and make a trade, which is something they're probably doing every single day, will be thinking about some of these things that we talked about. So I can't thank you enough for coming on and sharing us, some of this knowledge, some of this inside baseball from the professional world. And again, guys, if you're just tuning in for the first time, this is our Kaiju educational series we've been doing here at Benzinga every Tuesday, 11 a.m. Eastern, right here on our Benzinga channel. This is part 6 of 8 of the series. Check out part 7 next week. Same time, Ryan and I talk information, where to be getting your information. What do you
next
need
week
to...
is Christmas, buddy. I'm gonna miss you we're off for 2 weeks.
Man.
2 weeks back
Wait.
in the so here's the buy stop limit orders, a little Christmas gift for everybody. There, try that out. Hope it works for you. And we'll be back, I think, the second week of January. Back from Geneva. I'll have left this place and I'll be back in Switzerland.
Beautiful. Sorry about that. Yeah, we'll be back in a couple weeks. So
you're gonna be off
make
too,
sure,
Aaron. You're not trading next Tuesday. You're in a food coma at that point.
we'll see. I might be going long some of the Santa Sleigh Transportation Company. I don't know. We'll see next week. There might be some buying opportunity. You know what? My hot tip, my prediction. There will be some, BS Santa Claus coin crypto that's going to rally next week, and I'll probably be trading that.
I'm a seller of that coin. Just so we're clear. That
All right,
comes
well, there we
out.
go. We've got
I'm
a buyer. We've got a buyer. We've got a seller. We've got a market now.
Okay.
That's the first step. All right. Well, Ryan, again, thanks again. We'll be back in a couple weeks. If you guys, again, if this is your first episode, mark it on your calendar. 2 Tuesdays from now, we'll be back. Or I guess would it be 3 Tuesdays from now? No, 2 weeks from now. But then you guys can always go back and watch our former episodes. We've talked a lot about just how to set up your portfolio, how to set up a strategy, kind of all these different things that can really help take your trading, again, to that next level. I'm not saying all y'all are going to try to become professional traders, but that's not to say you can't use some of these tips from the professional trading world in your trading today and end up being a little bit more effective, maybe making a little bit more returns than you already were. So Ryan, thanks again. Where can folks find more about Kaiju?
If you're interested about what we do in terms of artificial intelligence in fund management, you can go to kcm.ai. That's our private fund manager. Or for the ETF, I think we're up probably almost 10% on the year for our completely autonomous AI curated and directed ETF DIP. You can go to dipetf.com or kaijuetfadvisors.com. So it's been a good year for that. Entirely self-directed, no human intervention whatsoever. So decent proof of concept there if you want to check it out. Predates on low to high mean reversion in S&P 500 stocks. Yay. So as a complement to your EV or SPY holdings, something that's risk of ruin of 0 and a little extended upside, overall.
There you go.
That's it for me. And happy Christmas.
Yeah.
Happy holiday.
Happy holidays, Merry Christmas, Ryan. Enjoy the time, in North America. It's good to know at least we're in the same hemisphere. We're in the same,
There's
continent,
snow in the
right?
background. There it is.
Yeah, there we go. But Ryan, again, yeah, just have a good time off, good time with your family. We'll be back in a couple weeks. Excited to get back to it. Till then, guys, stay green. Happy trading. Ryan, we'll chat soon.
Sounds good. Take care, Aaron.
You do the same. All right, guys. Ryan Pannell again from KAIJU. Links are in the chat to go check that out if you guys want to learn more about what KAIJU is doing when it comes to AI. Some really cool things. Like Ryan mentioned, pretty big year for that DIP ETF, ticker DIP. You guys want to check that out. And I'm always someone that is looking to buy the dips. I'm like the stock I was talking about earlier that I bought this morning. I was buying the dip on pretty hard, and it's been rewarding so far. But what's better than me going out and finding those stocks on dips to buy is when you don't have to do anything at all, and you've got an AI bot doing it for you, which is what KAIJU is doing with that dip ETF. So definitely something to go check out if you're looking for to be invested in a fund that you don't that is actively managed, and you don't got to worry about it because this AI thing's not going anywhere. It's going to be in every single day, no days off, always working for you. All right, guys, with that, I'll do a quick rundown of the markets. S&P 500, the SPY ETF up about 0.5% so far. Q's up 0.4%, so lagging slightly behind the S&P 500. Then your Dow is up nearly 0.6%. So leading today, looks like energy is having a big day, as well as financials helping the Dow outperform a little bit the overall market today. So again, guys, thanks again for tuning in to another one of our KAIJU educational series. Gonna take a couple weeks off, but we'll be back. And yeah, hope to see you guys there because we've got 2 more episodes of the series. And should be a great way to wrap up and finish this course where, again, the end goal is for you guys to just be, slightly to be better than you were before. And I'm not saying, you're gonna turn around and be getting Renaissance returns right away. But if you implement a lot of these things we're talking about, I am very confident that your trading will be better off than it was before you tuned in. So, stay tuned on Benzinga's channel. We have some more great content coming up. But with that, we're wrapping up. We'll be back. I'll be back on Thursday. And then I'll be back not next week at all on stream, but the week after. I'll be back in the office on Tuesday the 2nd. So first trading day of the year in 2024. I'll be here. I'll be making trades. So make sure to stick around.